Hi, this is a basic stock analysis video of PDD holdings, and this is just for school. So, um, not that anyone's going to actually watch this, but please do not use this for financial advice. Um, Please, I want to just learn more about stock analysis. This isn't actually a professional video. This is just for a school project. So, what is PDD? Well, it was founded in 2015, and well, you might know it from it has Temu. Temu is a really big online shopping website right now, but it originated in 2015 with Pinduoduo in China. So it's a multinational online commerce company, which just means that a lot of people all across the world buy from them on their platforms. And in China, it's mainly PDD, and in America, they launched it in 2022 with Temu. And not only do they have these companies, which are they're most known for, they also have several little smaller companies in tech. PDD claims to have over 900 million users on their platforms, which is a lot of people, and they're really known for having cheap products that are accessible to everyone. So they're really targeting price-sensitive consumers, and they launched the team purchase model, which is basically gathering a whole group of people to buy something in bulk so that the cost goes down. And they also do a lot of other promotional things on their apps, like if you spin the wheel, then you'll get like 25% off, that kind of thing. So they make it like an interactive experience so that you can purchase from them. They are traded on NASDAQ. They had initial public offering in 2018 at $19, which right now they're at 122. They gained so much. They have many competitors. So a lot of competitors within the online retail space. Right now in China, it's mainly Alibaba and JD.com. In 2023, they had revenues of 130 billion and 153 billion, and PDD had revenue of 34 billion, which is much smaller, but they are a growing company. So then I'm going to do a SWOT analysis just to go over the strengths of the company. And so it has a really large user base. It claims to have 900 million users on their apps, and they have really strong revenue growth. So they grew actually to 86% in the recent quarterly report compared to the same quarter in 2023. So that's really amazing. And they have the innovative social commerce model, which is their app is really communicative to consumers. So it has a lot of like the group purchase model, which is so they're constantly just making the app better. So that is their strength. And another opportunities is that they're expanding into international markets. In 2022, they launched Temu, and it's already really, really popular over here. And so their opportunities expand worldwide. For social media integration, a lot of right now, they could heighten their marketing, and that could be a huge opportunity for more people to just know about PDD and Temu. And they could also expand into different product categories, because right now, that ties into the weaknesses, but there's so many companies that offer cheap products, and they don't have anything different than what makes them different than another company that sells the same cheap products. They don't have anything that's really unique to them, that's really other than just being cheap. And so that's one of their big weaknesses. And even though I said that social media integration could be one of their opportunities, it's also one of their weaknesses, because they really rely on technology. Everything is based on the app. Everything is based on if the technology works. And if it doesn't, if they crash or if they're hacked, it's a huge disturbance to the company. And because they're based in China, and in Temu is a huge online retail space in the US, they could have big supply chain issues, which affects the supply of products to the US. So they have to, and a lot of their supply chain issues stem from having third-party suppliers. So they don't actually handle most of the supply chain. It's third parties. So that's a big weakness. And the threat is that they have intense competition. So in the previous slide, I mentioned about Alibaba and JD.com, but they could easily be kicked out by them and bought out. There are huge regulatory risks that are coming to them. In the annual report, they mentioned that in China-U.S. relations, because of them selling to the U.S. and being regulated in both countries, there's just a lot of political issues and legal issues that they're facing right now. Another thing is that there's an economic slowdown. So both in China and the U.S., inflation is a really big thing, and not many people, even though it's really cheap products from Temu, not everyone can buy them now because it's just an additional cost. So next we'll look at stock performance. So PDD, even though they had their initial IPO in 2018, I was just looking at the past 5-year performance, and it's amazing. They grew, their stock price grew over 200% compared to the S&P 500, which I'm just going to use as a benchmark, grew 92%. So they really outperformed the market. And just to go a bit deeper into the financial part of the project, looking into the revenue growth, they grew 89% revenue from 2022 to 2023 year, and that's incredible. Their gross margin increased by 60%, so the earnings before interest and taxes, compared to their sales, was 62%. So they do make a profit, and compared to Alibaba, they are doing much better because Alibaba is 37%. So their gross margin actually better than Alibaba, which is a competitor, which means that that could be their competitive edge. Their operating margin is 29% and the profit margin 29%. Basically, that just means that the company is profitable in the last year. The current ratio is 2.11, which means that they have around like double the amount of current assets compared to current liabilities, and the debt to equity ratio is 0.02, which actually was surprising to me because they're such a cheap company. I mean, not cheap company, but they sell such cheap products, and you would think that they're oh, sorry. It was a different train of thought. Debt to equity ratio, not the other thing that I was talking about. It just means that instead of getting money through debt, they're getting money through equity. So they're getting money through the stockholders. And so they have lower leverage because they have lower debt. And when you use debt, you can also get tax advantages and you can have faster growth because you have more access to money. But they have a really low debt to equity ratio. And their change in free cash flow was 95% in 2023, which means that, which is really good. That means that after investments, the cash they have in hand actually increased. And I think it's the debt to equity ratio, actually, wait a minute. Oh, return on equity, sorry. I don't know how to move this. Return on equity ratio is 50%, which is all right. The valuation these just continued over the ratio analysis, but the price to earnings ratio is 13.23, and compared to the S&P 500, which I'm using as a benchmark, it's 27.87. So actually the price that you're paying is it's undervalued compared to the market. But does that necessarily mean it's good? Well, I don't know yet, because just because it's undervalued, there could be many reasons it's undervalued. Like, do we know? Is it because it generally is undervalued because there's something that's going wrong with the company? Is there, we just don't know. But it is undervalued compared to the market. And the price to book ratio is 4.84. The price to sales ratio is 3.62. That just means that the price of the market, people will value it more than what's in the books and what are their sales. So people investors might have more confidence in the company than what their actual the book values are. And the enterprise value to earnings before interest, taxes, depreciation, and amortization, EBITDA, is 10. And searched online, that's also an all right number. I will ask about that tomorrow, about how to look at these ratios in a more analytical manner. But they don't have a dividend, and asset turnover, this is what I was thinking, but I said it in a different way, is 0.97, which is actually lower than I thought, because I thought that since they're an online commerce company, they have a lot of turnover because they sell a lot of things, but it's actually only 0.97, which is surprising. And I thought it would be higher. The return on assets is 17.25%. That is also good. So if we look at the actual, this is what I usually look at. And I just did the year to date. I was looking at, for this analysis, I was just seeing what is going on, if it's going up and down, if there's any stability or not. So basically, it's been a pretty volatile year. In September, there was a huge 35% drop because they had an earnings report lease. So basically, in the earnings report, the CEO said that they were uncertain about the future. You know, I don't know if there was a macroeconomic trend about the economy. So they also missed the target, even though the revenue increased 89%. That still missed the mark by a couple percentage points. So there was a huge 35% drop. But then China lowered the interest rates. And in October, there was a huge increase in stock price again. So it's just a lot of things are going on. China lowered the interest rates so that people would spend more to boost the economy. But it's now, the stock price is lowering again because of the general slowdown in the economy. Like, if just the big risk that if people don't have money to spend, they're not going to buy from Temu or Alibaba. So it has been a pretty volatile year. So some of the growth potential of risk, this is just summarizing. They have had huge revenue increases. They've done really well, like 89% increase in 2023 compared to 2022. That's amazing. However, if we look into the future, there's a lot of problems with U.S. and China relations right now. There's, in the annual report, they said they were having a lot more regulations, they were having more lawsuits, and that can just, that's a huge risk to the business, because Temu, a lot of Americans buy from Temu, and if any government, either Chinese government or American government, restricts trade, the whole company could get closed off. So another thing is third-party logistics. Since they rely on so many third-party for their supply chain, if any part of it fails, they can't ship it across the world, and that's just another huge risk. And another thing is their ability to keep up growth. Since they aren't funded through debt, they're mostly funded through equity. Are they able to keep up the growth without having that debt for funding them? And the other thing is they have intense competition. Even though they're selling cheap items, and I mentioned Alibaba and JD.com, which are mostly in China, they also have intense competition from Amazon, which is the biggest e-commerce retailer in America. So there's a lot of moving parts, and it's really uncertain about how it's going to be in the next coming years, and overall just a broader economic downturn. I've already mentioned this, but we don't know if, and like with inflation, everything's so expensive, you don't even have money for basics, and how are you going to buy from an e-commerce website? You're just not going to buy anything anymore. And that brings me to my conclusion, which is I am uncertain. And this is such a terrible conclusion. It's so like, what was the whole point of this? But basically, Um, I'm learning that stock analysis is actually like there's just a lot of factors at play, and especially just the U.S. and China relations. This company, I am very uncertain right now. But we'll see in the future. They are a growing company, and right now I don't feel 100% confident in what's going to happen, which you could say about anything, but I'm just uncertain. And with this terrible conclusion, I also listed the sources on, I'll list the sources in the description. But thank you.